Welcome to the trend module. This is quite literally the most important module that you'll see in this whole program by 2 billion country miles. It is the number one thing to know in trading. If you learn nothing else from this program, I would hope that this sticks with you. And if you're thinking in terms of the Pareto principle, 80-20 rule, you will get 80% of the results by following one of the most simplistic things. I made the mistake when I first started trading to denigrate trend because I thought that I was above it, that I was too smart. I had much more of a mathematical background, and why would I ever pay attention to this? The truth of the matter is that it is the number one thing. And if I had learned that right off the bat, I probably would have avoided going broke myself. Here's the thing. Even the most complex and complicated mathematical models of how assets are priced, like the Black-Scholes model, which won a Nobel Peace Prize in 1997 for, well, doing exactly that, are incomplete without having a trend. So the purpose of this program is to come from that mathematical background and apply it in a way that you're actually not even going to really see visually or explicitly, I should say, but you will be doing it just by the nature of following this sort of blueprint, which all begins with trend. One massively important thing to know about trend and why it is so valuable is that trends are more likely to continue than not. Now, if you're thinking in terms of statistics, generally speaking, trends have about a 70 to 80% probability of continuing in that direction. So it is unwise to bet against the current direction of the trend because long term, that would be like playing against the casino and you're not the house this time. In this lesson, you're going to learn how to identify trend. You're going to learn how to identify local lows and local highs, and you're going to learn how to identify trend using indicators, which will be a lot more of a simplistic look as well, and will put you in the right direction whenever you are confused. So that's where we'll start, and I'll see you in there. So now I'm going to share with you the ancient method of trend identification. And in order to do this, we need to go over several definitions, which we will then expand on in examples in the next subsequent video. So first things first, we need to understand what a local low and local high are. These are just any sort of high or low within the asset that we're looking at, really. So I'm going to just circle a local high right here and a local low right here. There are many highs and lows in between an overall trend. All of these are going to be examples of local highs and local lows. And again, we will go over this in more detail in the next video. Now, from local lows and local highs, we can extrapolate that to essentially understanding what the overall dominant trend is. Is this an uptrend or a downtrend? An uptrend is when we have a series of higher highs and higher lows. It would look something like this. Starting off with our low right here, we'd have a high right here, a higher low right here, another higher high right there, another higher low right there. You can see once you get one consecutive drive of that, that is your uptrend, higher highs and higher lows. A downtrend is going to be lower lows and lower highs. So for example, we have a low here, a high here, and a lower low here. And from there, we should also extrapolate this to the next thing that typically happens, which is either continuation or reversal. Continuation of trend is, for example, when you already have an uptrend, you see it continue. You get more higher highs and higher lows as time goes on. For example, you can see starting off right here with this general uptrend, we continue on, higher high, higher low, same high, kind of higher high, and higher low right here, and then certainly higher high right here. Therefore, that is continuation. Continuation is defined as when the trend, in the case of an uptrend, makes a new higher high. That's when continuation occurs, not when it makes a higher low. That just sets it up for potential continuation. Now, downtrend continuation is a downtrend that gets a new lower low, as you see in this example right here. We have a low, we have a high, and then we have a lower low right here. Therefore, continuation and the trend, as the name implies, continues to the downside. So just like continuation implies continuation of trend, reversals implies a reversal of the current trend. So that is when, in the case of an uptrend, we start to see lower lows and lower highs. A reversal is confirmed when you see that first lower low and then subsequent lower high. Once that happens, your trend is confirmed as reversed, and vice versa for, of course, uptrend as well. But let's go through it with an example. In this case right here, we have an uptrend. We have low, high, higher low, higher high. Now, in this case, when does reversal happen? When we get a lower low and lower high. Typically speaking, but not always, but 90% of the time, this is how it will work. You're going to see a lower high first, and then the reversal is confirmed when you get the lower low. So in this case, price comes down here, tries for a higher low, fails later on, as we can see, sets a lower high right here. That's your first major warning sign. Once that happens, be aware the trend is changing or potential to change. Once price comes back down and breaks this prior low here, just anywhere below there on a closing basis, reversal confirmed. We now have a downtrend, and as you can see, the trend remains your friend because it continues on for the next over a year. We're now going to go over a downtrend to uptrend reversal. So again, same example, high, low, lower high, lower low, lower high, lower low, lower high, lower low. Then what happens? We see a first higher low right here. It's very slight. This is actually typically how it does work on like the macro reversals. From there, once you get the higher low, what confirms the reversal? Of course, it would be the higher high trading above the past prior lower high, which is right here. Once that happens, we have a reversal on our hands, and as you can see on the chart, it continues on for quite some time. This is why trends are so important to understand, because they are the prime driver of overall direction of price. When you see a trend reverse, pay attention, because the trend will be your friend until the very end of the trend. In the next video, we're going to go over some specific examples on how to define local lows and local highs, and then a few more with trending highs and lows as well. I'll see you there. So in the prior video, we went over definitions. Now I want to go over some examples. And ultimately, the purpose of this portion of the course is so that you can very quickly and easily identify trends, whether it's an uptrend or a downtrend, as that is the most important portion of this overall model. And it's very important that you can not just have to rely on indicators, but also be able to do it yourself, because in some cases, the indicators might be leading you astray, and you'll be able to quickly identify, all right, I actually know what's going on here, and I'm going to ignore that for now. Okay, so first things first, how do you identify a low or high? Well, it is essentially a stop and reverse point in the overall trend. What is a stop and reverse point? Well, for example, on the chart right here, we see a stop to the downtrend, and it reverses right here. It takes 1, 2, 3 closures, so that is on the lower end of what we kind of expect. A general rule that I could give you to get rid of a lot of ambiguity with this is to simply look at closures between 3 and 7 as most likely to create highs and lows. If it's less than 3 or more than 7, it's probably not a high or a low. It's probably inconsequential and you should just ignore it generally. Or maybe it's a little bit too close to everything that's going on, or even too far away as well. Those are signs that it's not what we're looking for here. So an example of stop and reverse points that are just too close to each other that don't really matter would be specifically this one right here and this one right here, because you can clearly see, okay, price comes down and then it goes up for 1 bar and then it comes down again for 2 bars. In this case, it's not consequential. They're literally right next to each other. These are not highs and lows that we're concerned with. We're concerned with the ones that create the overall trend. In this case, it would be this one right here and this one right here. Of course, this would be an example of an uptrend. Why? Because we have a low, we have a high, we have a higher low, and as soon as price goes back above this prior high right here, we have a higher high. Now, I just want to highlight the importance of the last low right here, this particular one that my cursor is currently on, because it created the new higher high. So it was the last low before a new high was printed on price. If and when price comes back down below this low, that is when you have a reversal in your hands. Usually you'll see a lower high beforehand along the way, in this case right here, and even an attempt for a higher low. But because this higher low right here was coupled with a lower high right here, we don't have any trend. We have a higher low, okay, great, but no higher high, just a lower high. So it's a consolidation letting us know something new is likely about to occur. And in this case, that is confirmed when it comes back down below this prior trending higher low. So I just want to recap really quickly here. Don't go overboard with marking every little twist and turn on the charts as a higher low or lower high or any sort of lower high. We're only concerned with the ones that generate the overall trend. And of course, in the case of an uptrend, these are the ones that create a higher high, or in the case of a downtrend, these are the ones that create a lower low. Those are the ones that we are most concerned with that can be an indication of reversal. Okay, so now let's go over an overall uptrend example, and then we'll extrapolate that over time as actually the market cycle changes. But in this case, we have a low and we have a high. This is a very important trending higher low. Why? Because price made a new high from that above the prior high, which was over here. Okay, after that, price comes back down and sets in a higher low. I'm going to ask you a very quick question here. Why was this not a higher low and this not a lower high? Well, the answer should be somewhat obvious in the sense that these are too close to that high, as we can see right here. And this is very obviously 1, 2, 3 bars. That is legitimate. After that, we don't really have anything there. It's really just a line if we think about it in terms of price. From there, price action comes down, sets in the higher low compared to this prior low right here. Okay, it's not a great arrow, but you get the idea. Anyways, from there, trend marches back on up, makes a new high. So that is our higher high, pops back down 1, 2, 3 bars. And in this case, this actually is an example of 3 and 3 on both sides. So we have 1, 2, 3 on the top side, and then 1, 2 on the bottom side. This is a rare example where you do get that. Yes, it's going to be a lot more obvious on a daily time frame. And of course, this is why you should be kind of shifting around different time frames, just get an overall idea of where things are, as obviously a lower term time frame is going to precede a higher term time frame. That is to say, you're going to see a higher low on a lower term time frame first before you see it on a higher time frame. Okay, from there, price marches back on up, makes a new high right here, makes a new low right there. Again, higher high and higher low. Trend continues into the next portion right here, higher high, higher low, both having 3 bars in between as the actual high and low. This one over here, higher high, higher low. These actually both do have 3 bars as well. I know it doesn't look like it on the chart, but these actually do have 3 bars. Marches up again. We have a very quick one right here. This is an example where I would say, no, this is not a higher high or higher low. I mean, it is a higher high to be fair, but it is not a consequential higher high or higher low. Price really just goes parabolic here. And your next significant higher high is right here. That is the one that of course matters for a trend. As long as Bitcoin is below there, it's not continuation. It's potential for reversal. And that's exactly what we get. Price comes back down. Again, this is an example where you'd see it on a daily. You see a higher low right there and a lower high right there. On a weekly, no, it's not going to show up. We go to our next low here. Why? We have some actual space in between the high and low. Again, all of these you will notice have, some decent space in between them. And then it pops back up and sets in your lower high. Big red flag. After we get a lower high after an uptrend, what should we be looking for? Potential for reversal. How is reversal confirmed? By coming back down below the last higher low. In this case, when price comes back down and cracks below this low right here, that is creation of a lower low. Thus we have reversal, and you get your new lower low right here, marches into a next lower high right here, lower low, lower high, and then we get a series of basically the same lows, which will happen during a consolidation. And that either a consolidation, of course, can either lead towards continuation or reversal. Same rules apply. The second that it actually creates a new low and closes below that, that is your continuation of trend, in this case to the downside, with those lower highs in place. Generally, if you are getting, in this case, the same lows, it's probably going to be continuation of whatever the current dominant trend is, in this case to the downside. If we got a bunch of same highs, probably going to be a reversal or continuation to the upside. And I just want to say, up until this point, if you're feeling a little bit unsure or confused, it's completely fine. You're going to become more comfortable with this naturally over time as you get more and more familiar with it. Our solution for that is in the next video. We're going to go over our next tool, another indicator, which is the exponential moving average, which is going to essentially tell you what the trend is about 90% of the time. For the other 10% of the time, you can use these methods over here. And like I said, don't worry, you're going to become more comfortable with this naturally over time. I'll see you there. exponential moving averages. This is going to be our tool to define trend in a little bit more of an objective way. EMAs are essentially moving averages that are just more weighted upon the current price action. So they're a bit more responsive to what's going on in the present rather than the past, which makes them a little bit more accurate in my experience and a little bit more forwards thinking despite being a lagging indicator. So I should also explain that EMAs, while they are very adept at getting the overall trend, they are not perfect. And that is why it's important to also use your own judgment when looking at the local lows and local highs, as we did in the prior video. First things first, let's find where the EMAs are on TradingView and show how to set them up. So you're going to go to the indicators tab right here, and that's going to bring up the public library. And I want to share with you a specific script that one of my good friends has made, and it is called CTMAC. You're going to select this indicator here called the CT Moving Average Crossover Indicator. It's by the Caretaker. Currently it has about 1,100 likes. And that will populate this in the background here. Don't let this confuse you. We need to format this. So what we're going to do is we're going to go over to the settings. So just highlight the indicator at the top left-hand side. Just follow my cursor and hit the settings cog. That's going to bring up this window here. And we're going to start to make this look a little bit more pretty because we're visual people and that's better. And you're going to be looking at these charts a lot. So it's good to make these as nice as possible. So first things first, I want to get rid of the info panel. We don't need that right now. We need to identify and manipulate these inputs here. So I'm going to get rid of this, and this. We're going to only have 3 very specific ones. We're going to have a 9 EMA. We're going to have the 21 EMA. It's going to be our yellow. I'm going to make it a nice big and bright yellow. That's what I want for this one. And this one I'm going to make cyan because I want it to be a different color. I want this to be very, very obvious. And then I am going to have a green, a very nice vibrant green as my 55. Now the 21 and 55 are Fibonacci numbers, which we'll go over later on in this program, but there's a very specific reason for that. The 9 is something that I like to use personally that gives a bit of a bias as to what the more short-term price action is doing, which we'll get into later as well. Anyways, once you've done that, your charts should look basically like this. You'll have 3 different moving averages. If you followed my color scheme, you'll have that cyan, you'll have the yellow, and you have the 55, or the green 55, I should say. And those are our settings. So you're probably asking yourself why these 3 moving averages and why these periods? Well, this is the backbone of what the rest of the system is built upon in defining trend and then gauging strength of trend. And I like to call this setup the crown cross, a very egotistical name. I apologize about that, but we're going to expand upon this in the next video where we go over how to define all of these different moving parts and put it into the overall system. So now let's get into how to actually use and interpret these exponential moving averages. All right, so on the chart right here, like I said, we have 3 different moving averages. We have a 9, a 21, and 55. Intuitively, we can understand that when a lower period, like a 21, crosses a higher period, like a 55, that is an indication of the trend strengthening in the direction of an uptrend. So whichever position the lower period is in relation to the higher period is where the trend is likely heading. And the specific relationship between the 21 and 55, which on my chart is the yellow and the green, is what we're going to use to define the direction of the current trend. So for example here, we can see on the weekly time frame, the 21, the yellow, crossed the green right here at this exact point. And while it wasn't perfect, it was pretty damn good at getting the reversal from uptrend to downtrend. Remember, in the prior video, we went over how this was the bull trap of 2022. And if we were essentially going off of moving averages, we would have realized a few closures later, hey, the trend is reversing here as that flipped. Let's do the opposite as well. We can also see an example of an uptrend emerging. Right here, we see the yellow 21 cross the upside of the green 55 and Bitcoin up. So just blindly following these will not be right 100% of the time, and they won't be the first They usually won't tell you first, but they'll be right about 90% of the time, and they'll be very close. So it's a good thing to use in addition to your own sort of intuition or discretion, I should say. Now, you will naturally find stuff like this as well, where the yellow 21 and green 55 can basically cross and crisscross back and forths. This will happen, and that is something that is it's just a part of the game, and we deal with it as it comes. That's why this was essentially a black swan, in a way, fake out on overall direction, and later on the real trend did emerge. What then is the importance of the cyan moving average, the lowest period here, the 9? Well, it does a few different things. First, when price is above all 3 major moving averages, like you see right here, and trending above that lowest period moving average, that is when I like to call it a trend in motion. So as you can see here, this happens exactly at this moment. And then from there, as long as the trend is going, it's pretty much riding that 9 period moving average the whole way until the market actually reverses. As you can see, again, blindly following this on this time frame would have been a pretty good move long term. It wasn't going to be perfect, but you don't need to be perfect in order to make a ton of money. Now that we have that, let's talk about the importance of when the 9 crosses the 21 in this overall sort of positioning here. Well, that is an indication that we're going to see a correction income. Now, a correction in the context of the current trend typically does mean to look for a higher low first. Now, in this case, it's actually not the case, but in this case, we can see that when the 9 crosses the 21, we get an overall corrective period, more importantly, somewhere around the green moving average, the 55. Price almost always will come down to this moving average here when these two cross here. In many cases, it will also overshoot if it is an uptrend. If it's a downtrend, actually less so, as we'll go over soon. But as you can see here, price action pretty much does bottom perfectly on the 55. And well, we get a trend yet again to new all-time highs soon after that as the moving averages once again fan out. Now, I want to go over the opposite or downside crosses, the more fun ones. Let me find some good examples here. Maybe not the best on a weekly. Let's go down to a daily. Okay. Let's start from the fake out, the bull trap of 2022 here. We see the 21 and 55 cross right here from uptrend to downtrend, and then that cyan moving average is leading it. So we didn't just flip the trend, it is trend in motion after this quick fake out. And that's typically how things will move after a fake out like that, just as an aside. From there, you can see that as long as the cyan 9 exponential is below the 21 yellow exponential, price is essentially in trending motion the whole way. And it's not until we see it cross all the way over here, when price was all the way down at 21,000 bucks, where we actually see that first real correction into the green 55. And it spends a lot of time there. We do not see, however, the cross here between the yellow 20 and 55, which means that our bias should overall be looking for continuation of trend. And that's exactly what we got in this case overall after this failed high right there. Continuation. We get a quick fake out right here, and then some more down. Again, they're not going to be perfect, but they're going to get you in the right direction more often than not. So now I want to share with you the sort of picture perfect cross that you will very likely notice at some point in your trading career. This works on all different time frames, and in my experience, whenever you see this happen, it's very much worth paying attention to because the trend is very likely to continue and very likely to continue a lot. A great example would be right here, actually coming after the Corona dump in 2020. Price is consolidating in this region right here as all of the major moving averages are bunched up right next to each other. Now, consolidation in the context of trading just means that price is, well, it's kind of like grouping up in a very tight range, in a very small area, as you can see. And when you see that alongside the major moving averages not just being very close to price, but also being close to each other, as you see here, and then that sort of gets spit out and buoyed around, and you see this one just, well, the moving averages fan out, I guess would also be another good way of stating this, is an incredibly strong trend. And this one, again, basically goes all the way until the next major macro reversal. So it all starts with this right here. Whenever you see that, whether it be to the upside or the downside, pay attention, because that's very likely a strong trend emerging. And you will see it will be essentially confirmed as a strong trend now in motion when you see price action starting to ride on top of the cyan 9 exponential moving average as the moving averages themselves fan out and price just maintains it the whole way through. And in that case, if you're wondering for what would have been a good way to just keep yourself generally long from May of 2020 to basically the highs of 2021, this would be it. It's not going to be perfect. It's not going to get the whole move, but it gets the majority of the move. And that's what we're looking for. So now that you know how to define local lows and local highs and the overall direction of the trend, as well as use exponential moving averages, we're going to go into the next core concept of this program, which is volatility. I'll see you in there. So first, let's define what volatility is. The dictionary definition of volatility is the dispersion of returns. Now, it's probably not a super tangible definition. I know for myself that didn't really make too much sense at the beginning, but a more working definition would be to explain the sort of interpretations of what volatility does at certain points, which is this. When you are feeling extremely emotional because price is going up and down super fast and going in all these diverse ranges and just really making your heart race, that would be an example of high volatility. When price is really boring and you check your trading view or you check your portfolios and you see no change, no change, no change, that would be low volatility. So realistically, I want you to think of volatility as like a heartbeat. A heartbeat at rest is naturally a very low heartbeat. And when you're at rest for a long time, it doesn't take too much of a stimulus to cause that heartbeat to really rise rapidly. Now think of it as this. You've been resting for a long time, you haven't gone to the gym for years, and then all of a sudden, one day you decide to do the most intense, high-intensity interval training circuit, and your heart rate goes through the roof. That would be like volatility going up and up and up. But just like your heart rate has a sort of limit as to how high it can get before it, well, can't go any higher and actually must come down, so does volatility. So you can understand that in the mathematical way, without actually knowing the mathematics, that volatility is a mean reverting indicator. So as a mean reverting indicator, that means that volatility, after it gets super high, instead of your heart rate going, to 1,000 beats per minute, which is impossible, it will naturally come down as you calm down because your body forces you to stop. You cannot operate at that high level for forever. So when volatility is very, very high, we also can then understand intuitively that this move is unlikely to continue in its current direction and is likely to then come back down into a state of rest. High volatility precedes low volatility, and low volatility precedes high volatility. The last thing about volatility is that it is direction neutral. While it gives us a bias on when and perhaps how severe and emotional a move might be, it does not give us a bias on direction. We use our other tools for that, like trend, and as we'll later go on, momentum, but volatility is specifically not directionally related. So with that said, we're going to get into the actual indicators that we'll use for volatility and how we'll use it for volatility. So I'll see you in there. In the context of this program, we're going to use an indicator for volatility called the Bollinger Band Width Percentile, or as we'll just say for short, BBWP. So first things first, how do we actually find this on our trading view, as it is a public indicator? We simply go to the indicators tab, which brings up the public library, and we type in BBWP. And we select the one by, again, the caretaker. If you're familiar with myself or my content, then you certainly know that he is one of my most trusted developers. So that'll bring up this indicator here in this pane. Next thing we need to go over is a few settings for this, which it should come as default correctly, but let's just make sure everything's all set. We want price source to be closed. We want basis type to be SMA, length to be 13, and look back to be 252. And then also if we're going to be using a moving average on it, we'll use the simple and we'll use a 5. Should be default, but in any case that it's not, that would be the settings that we use. If I want to explain why we use these settings for the nerds out there, the look back is 252 simply because there are 252 days in the real trading year. When I say real trading year, I mean the professional calendar, which is what traditional markets trade off of. And now that Bitcoin especially trades on traditional markets and we see most of the action happen during that time, this makes even more sense. So now that we have that, I need to explain to you what percentile is. So to explain the term percentile, I think is best done with an example. All right. So in this case, I am going to highlight with a green vertical bar the current portion of BBWP that is being printed, which is right here. At the top left-hand side of the screen, you will see the nominal value in the colored number, which is 82.14% percentile, actually. What that means in the context of percentile is that the current level of volatility is higher than 82.14% of the look back data. The look back, as we went over earlier, is 252 past bars. So this particular bar right here, in terms of volatility, is experiencing higher volatility than 82.14% of the last 252 closures. Why is it important to understand percentile? Well, it gives you a measurement that gives you a basis to relate something upon. So if this is very volatile compared to the past, we can look at that as likely getting into an area where we're probably witnessing a local high in this case, as price is currently put in a local high, actually, as you would imagine. So we expect volatile moves on these sort of trending moves right here. We expect volatility to contract or to pull back and come down while price action consolidates or regroups after these trending moves. So what we would expect to see next on this is that there's going to be a period where the BBWP, measuring that volatility, starts to curl back down and come back down lower. You will notice that these particularly low reads of BBWP, like you see right here, and also certainly in this area right here, were rather boring areas on price action. If you were around during this time, this was the 3 or 4 weeks after the ETF was listed for Bitcoin, and Bitcoin went into a very tight sideways range. If we were to put on a line chart here, you'd basically see no change at all, which is essentially a representation of a consolidation as verified by the BBWP. Now, again, just like that heartbeat, when BBWP gets very low, then it is mathematically inclined to expand. So we look at that as a base for price action to set in a local low or local high. And from there, in this case, we see trend continuation. But we would expect to see an explosive move. Again, direction neutral, so we don't have any bias on direction. Of course, if we viewed the prior lesson, then we know that because the trend in this case was up, that expansion was likely to lead towards continuation in this case. And so that's how these things kind of go hand in hand. So now that you know the basics of the BBWP, I want to go into a few nuances that will give you an advantage in deciding when things are most likely to come to an end versus likely to begin. So now I want to go over a nuance with interpreting the BBWP indicator in terms of whether it's likely to contract or expand. Again, contraction means that we're going from high volatility to low volatility, which is what we expect to happen after an explosive move. And also on the other side, when it goes from low volatility to high volatility. So here's a perfect example to illustrate the nuances of volatility. So this right here was the sort of beginning of Q4 of 2022. If you're around during that time, you know that the market was hanging around about $20,000 for Bitcoin. And what happened after that?
This is fine.
Now, the months leading into that FTX collapse, we can see here, volatility was extremely low. extremely low, which let us know that there was a big move being built up from this. And another sort of nuance with volatility that I should explain, or with the BBWP, is that the longer that it stays lower, the bigger the expansion or explosion is likely to be. And we certainly got an explosion, as you can see, with price action cratering down almost immediately over the course of a few days. In this case, it was like 30% or so, which led to an explosion in volatility right here. Now, the nuance I want to share with you in sort of timing this is that when we actually blow up this BBWP indicator right here, we see two moving parts, right? We see the BBWP and we see that moving average. The moving average is the white part. Once the BBWP starts to move below the moving average, and especially once they both get negative slopes, or they're just curved to the downside, that's when we have an extremely high probability set up that this move to the downside is over. So think about it this way. If you were perhaps one of those people in 2022 thinking that price was going to go down to 12,000, 10,000, 3,000, 0, you would have known that at least it wasn't likely to happen from this exact posture right here, because volatility was going into a contraction phase. And as you can see, that contraction phase was tremendously long. I certainly remember this time as being one of the most boring times in Bitcoin's history. And that's saying a lot, actually, because there's been some boring times for sure. But again, the longer that it stays low, the bigger the explosion is likely to be. And what do you see after that? We see expansion yet again. And expansion is really confirmed once we see the BBWP get above the moving average, both having that positive curvature, and especially when the BBWP starts to move above about 36 to 38 percentile. But that's a very specific number, just anywhere above this region right here, high degree of expansion underway. And what do you know? On the charts right here, what do we see? We see an absolutely explosive move to the upside. Bitcoin goes almost immediately 40% move to the upside over the course of 3 weeks, goes into yet another contraction phase right here. So we get a short-term sort of sideways, right? This was over the course of a few weeks, actually, almost a month there. Sets in a higher low, and then expansion leads towards a slightly new high right here. After that, we play the same sort of playbook over a few times. A little bit of contraction, a little bit of expansion, and same thing going onwards and forwards. So again, the real value in BBWP is being able to time these sort of moves and have an understanding when the move is likely to end versus when it's likely to begin as well. So you can avoid getting caught into this sort of purgatory where you're wondering, okay, this thing's going up and I'm holding on to it and I'm having a lot of profits. When should I close? When BBWP gets very, very high, you have a high probability that the current price action is likely to stop. It might continue on later on, but it's likely to stop here, and you can take profit, regroup, reanalyze, and wait for the next signal. So now that we've learned about the BBWP and we learned how volatility works within this overall system, I want to bring you into the next lesson with momentum as our last piece of edge that fits into this overall system that will give you an advantage. Momentum. In this whole system that we're creating for the purpose of trading, momentum takes the third and final position in terms of importance. If I were to rank everything, it is all in order, with trend definitely first, volatility second, but a close second, and the momentum, while it is the next one, there's no like third or fourth or fifth. It's like number 6 or 7 or 8. It's not as important, and it is certainly context dependent, which is what I believe everyone mostly gets wrong with momentum and momentum oscillators, is that they look at the signals from momentum oscillators as infallible, when really momentum oscillators are completely inconsequential on their own. They must be used in combination with the other two portions, the other two moving parts of our system, which is 1, trend, or 2, volatility. One or two of those, or both, must be used in conjunction with momentum. Otherwise, it will completely lead you astray over time and lead to, in my experience, financial ruin. With that said, momentum, we want to use those two other other factors to filter in the high quality signals and filter out a lot of the noise so that we can create a more high quality and efficacious portion of edge for our strategy. So in this lesson, you're going to learn where to position momentum within this system and how to pair it up with our other moving factors with trend and volatility so that we can create an ongoing and fully functional trading strategy. Now it's time to define what momentum means within the context of trading, and also to go over the momentum oscillator that we'll be using, the stochastic oscillator, with settings that are specific to our purposes with crypto. So what is momentum? The dictionary definition for momentum is that it can be understood as the velocity or rate of acceleration of the current trend. It's a very key portion right there of the current trend because that implies a context of directionality. I want to bring to you maybe another analogy that might, nail in this point a bit more, which would be a car analogy, because we all, we're guys, we like car analogies. It's good. If you're a girl, you also probably have driven a car, so it's also good. Anyways, what is it with a car? Well, when you put your foot on the gas pedal and accelerate the car, that is the same thing as a momentum oscillator starting to gain momentum, which translates to the asset moving in the direction that the car's wheels are positioned. So again, we have a context of direction here with this particular analogy, which is the absolute key portion. Now, as you press more and more, the faster and faster it goes, gains more momentum, and on you go forwards. So for the purposes of this program, we're going to go over one of my most favorite momentum oscillators, which is the stochastic momentum oscillator. So now let's find where the stochastic oscillator is on TradingView and format it specifically for cryptocurrencies. First things first, we go to our indicators and strategies tab here. You can also just press backspace on your keyboard, which will bring up this tab here. In the text box, type in Stoke for short, which will bring up this list under technicals. And we're going to specifically press on the stochastic here, not stochastic RSI, but specifically just the regular stochastic. And that will populate something that looks like this in the bottom pane. Once we have that up, we want to change in the settings, which are found at the top left-hand side under the Stoke tab, the %K and the %D. And we want to change it respectively to 6 and 3. That will start to look like this in the background. So just take a second to make sure that these are the correct settings. Again, %K should come default at 14, %K smoothing 6, %D smoothing 3. These settings will be a lot more appropriate for cryptocurrency. They move a little bit slower, but their signals have a higher hit rate and higher fidelity just right out of the box. So now that we've set up the stochastic oscillator, in the next video, we're going to learn how to interpret this within the context of this system. I'll see you there. Stochastic with trend. So first things first, we are going to put stochastic momentum within the context of our general trend. In this particular example, we're going to use our EMAs from the prior module with the 21 and 55 and 9 exponential moving averages. And then we're going to use the stochastic oscillator just as we positioned it in the prior video. So in this case, we are going to first identify trend. That is the most important part. And we'll start on the left-hand side right here, where we can see all major moving averages start trading in the upside trending direction. All lower periods, in other words, are trading above higher periods. Specifically, the 21 yellow and the green 55. Those are the big ones for the general trend. Once we see that, then we look only for stochastic momentum crosses to the upside direction. Or if it's already crossing the upside direction, that would also be an effective continuation signal. And in this case, we can see during that cross, it actually was positioned to the upside. So one, we could use this as an extra confirmation tool that this cross to the upside on these moving averages was likely to play out in this case, a very big fashion. And two, we can use it as an indication that this one's ready to move like now, as you can see. Not only that, but it was a perfect example of the moving averages all kind of being bunched up there as well as price gets buoyed up upon them. Anyways, from there, we see several crosses to the downside, and I will mark these off right here, and well, those are the big ones. And as you can see, if we would have taken those as signals, these would have been terrible entries, which I just want to really hammer in the point that when you trade against the trend, when you take signals against the trend, you are really playing with fire here. This is a great way to lose money. I strongly suggest don't do this. You don't need to do this. Anyways, from there, we do see a signal where it crosses to the upside right here around the neutral zone. So in this case, this one once again does produce another upside move. Now, this brings up a bit of a nuance with the stochastic oscillator itself. When we are trading with the same direction as a trend, in this case to the upside, we want to generally ignore signals that are coming from upside crosses that are especially above the critical zone like you see right here. And usually anything that really comes between the top end portion and the 60 level right here, which is where my green horizontal bar is. Those signals, yes, they will sometimes play out in a very strong trend. However, when we're thinking in terms of probabilities, our probabilistic setup there is going down and down and down. So we want to really focus on the good ones that happen with upside crosses below this level, while the trend in this case is to the upside. So let's get rid of these prior iterations here. Let's move on to the next example. Where is our next momentum cross to the upside? That would be, of course, right here. Trend is still to the upside, and we get some continuation. In this case, the overall trend does continue, but it goes into a sideways consolidation. But generally speaking, when we're using our trending moving averages here, we never see the 21 and 55 cross to the downside, I should say. The 9 and the 21 do cross, which does imply that there is a consolidation incoming. But because the 21 and 55 do not cross, the interpretation of this is that that consolidation is likely to lead towards continuation of the current trend, which is still to the upside. And that's exactly what we get after several more crosses to the upside. While this is all present, I'll mark them off, and you can see all of these would have been fine points to re-enter, or if you had taken profit from before, you could have re-entered in these areas as well. And once again, we do see that on this last one, especially around this 40 read right here, which is another one of those major areas to be aware of whenever you see stochastic momentum crosses in this region to the upside within the context of an uptrend. These are going to be your friend, as you see immediately after that, and we get to play the game so on and so forth from there. So now let's go over the opposite but equal format of this particular setup, which is a downtrend setup, meaning that we're only going to be looking for those stochastic momentum crosses to the downside, particularly the ones around the 60 read right here. So it's kind of like the opposite but equal of what we just looked at for the uptrending ones. These are the ones that usually have a high degree. And as you can see, the trend as far as our EMAs go is certainly to the downside this whole way through. And there are several instances where we do see crosses kind of around the same area. In some cases a little bit higher, in some cases a little bit lower. That's okay. But all of these are just beautiful examples of major trending moves in motion that actually inevitably lead to a phenomenal move right here. And again, it was the trend that tells you to stay in these trades, and the momentum oscillator led by the stochastic that tells you when this is likely to start to move in that direction so you can get to positioning. And that is the big thing with stochastic momentum. Again, context dependent with the direction of the trend. We ignore signals on the other side. We're not looking for that. We're looking for other indications. So now that you understand the relationship between trend and momentum, we're going to pair it up with the second piece of edge within this overall system, volatility. I'll see you in there. Now that we've gone over trend and momentum, let's go over volatility and momentum. Remember, volatility's role within the system is to give us an indication on timing and when, and also an indication on kind of how severe of a move we're likely to expect. Bigger and longer forms of low volatility do correlate with more explosive price action that is likely to have even more continuation. Okay, in this case, you can see that we brought back our good old friend, the BBWP. I've changed the colors here on the stochastic because it needs to match the chart, and that's very important as well. Choose whatever colors you so desire, by the way. And I want to go over a very simple setup here. The idea is this: low periods of volatility correlated with the direction of the stochastic oscillator freshly turning around a critical zone correlate with major trending moves. And in this case, we can identify a period of low volatility starting here. Remember, any sort of volatility that is below about the 40 read, that is where we consider this is low volatility. So it's time to be paying attention, and I'll actually mark this off with the green vertical bar. Okay, once that happens and once we start to see volatility represented by the BBWP face off. Then we go ahead and we wait for a nice turn around the critical zone on the stochastic oscillator, which in this case, we can see it's already in the critical bullish control zone or critical bull zone there, which means that this cross to the downside is likely to be an explosive move. It's more likely to be an explosive move, I should say. And once it starts to cross down alongside volatility becoming more mature, again, the sort of next portion that we're looking to confirm volatility expansion is volatility moving up with the moving average following, both having positive slopes. That happens right here. And what do you know? This move continues down for, let's actually measure this one out, about a 10% move to the downside on what I would consider more of a lower term time frame. Now, from there, you can see that volatility explodes. So not only does volatility help us time when that move is likely to happen to the downside, but it also lets us know about when things are likely to stop. And remember, anytime that volatility starts to get above 70 percentile, which in this case it just kisses, we can look at that as a high probability area that this move is mostly done. Of course, things can explode more, and they do explode more, but by the nature of it, above 70 percentile is, well, not that often, as that would be more than 70% relative to the look back period. So just by definition, just by statistical definition, that's not an often occurrence. It happens 30% of the time. So if we're thinking in terms of, hey, take the money while it's in your hand and run, once it gets around 70 percentile, that would be a good time to at least realize some. So in this case, we see a few more setups. In this case, we actually see another one on the other side of the market. We see the volatility cool off, go back down into that, we see the heartbeat kind of cool off right here, goes back below the sort of contraction area that we marked off at 40 percentile, starts to base and turn around. And during that time, what's our stochastic oscillator doing? It's bottoming out around the bottom side of the bullish control zone here and turning up, letting us know that the next sort of explosion in volatility is likely to lead towards an upside move. And on price action, that's exactly what we get yet again here for almost a 20% move to the upside. And what do you know? The BBWP getting above 70 percentile catches the strong majority of this move. It certainly moves higher towards 87 percentile, but even then, this was basically the top of that short-term move anyways. So let's do a quick recap here. The key part of this lesson is that when volatility is very low and stochastic momentum is near one of the critical zones and freshly turning, we have a likely explosive trade on our hands, which then we can use volatility again to judge when that movement is likely to end. So not only can we time things and the direction of them, but we can also time about when the majority of that move is already done, and it's good practice to be taking at least some partial profits, if not everything. On the next lesson, we are going to bring all of these pieces of edge together to create the blueprint that you can then build for your own trading system and iterate upon. I'll see you in there. Up until this point, you've probably been having these slight glimpses of, oh, I get it now. I'm starting to fit these puzzle pieces together. This goes with this, that goes with that. And you probably had an inkling of where I'm going with this, but I want to, in this particular lesson, explicitly fit all of these moving parts together so that we have a cohesive system which is backed by real hardcore mathematics. When I first had this realization, it just blew my mind. And I'm sure that for yourself, you might be experiencing something similar as well right now. So let's go through and fit all these things together, and you can trust in that truth that this is backed by those sort of very complex but important pricing mathematical models. So now it's time to create your system based off of this blueprint, and I'll see you in there. So let's recap this whole system, starting off with the importance of trend. Trend gives us the bias on directionality. It lets us know whether we're in an uptrend or a downtrend. And because trends are likely to continue, we want to position ourselves in that same direction. But just positioning ourselves in that same direction without some sort of moniker on timing is Not very helpful, which is why we then use volatility, the second portion of this system. Volatility helps us time when that trend is, one, likely to go into a consolidation, which can lead to continuation, which gives us an opportunity to jump in on a higher low in the case of an uptrend or a lower high in the case of a downtrend. Then we can use volatility, of course, to understand about when is a good time to be realizing some profits, assuming that we're in some. And then, of course, momentum is going to be that third but less important part of this whole system that is more like a secondary confirmation alongside volatility and trend, which lets us know that, hey, this is a likely good signal for a higher low or lower high, depending upon the direction of the trend. And from there, we're going to fit all these puzzle pieces in together and go over a few examples together of what the perfect setup looks like for both an upside direction and a downside direction. I should at the outset let you know this whole ideology works for just about any time frame on any asset, but you're going to find different nuances here and there, which perhaps we go over later. So in the next video, we're going to go over the first perfect long example or upside trending example, and I'll see you in there. Now that we've gone over a few upside examples, let's go over the opposite but equal setup for the downside. Again, I'm on the 4-hour time frame here. You can use whatever time frame you want, but I think that this example right here really illustrates the point well. In this case, we have the crown cross to the downside. The yellow 21 is below the green 55, and it goes into a consolidation right around here, around the 55. In this case, we can see that the BBWP goes into a very, very quick and aggressive contraction phase, immediately dropping off all the way down to even single-digit percentiles, letting us know that this is a very, very important level, even with these blue bars back here, which just signify that this is an extreme low. And from there, we can see that stochastic momentum is actually crossed this whole way down. So we basically have a green light in this case to enter in immediately once all these conditions are met. In this case, the stochastic oscillator is crossing down again in that bullish control zone. So this is picture perfect. And from there, we can see that price craters from the entry to the next major closure of almost 18% in the next 3 days. And you know that this move is likely to end there because the BBWP goes way into the D percentiles here. In fact, it even hits 100 percentile for multiple closures on the exact low. And in this case, that would have been a great place to be taking profit and potentially reposition later, of which we get another example a little bit after that, which is going to be further on down the trend, right around here. And once again, we see the crown cross to the downside, the 9 leads the 21 leads the 55, and from there, we're looking for periods of low volatility. We see a couple on the chart right here and right here. Both are valid, both are completely fine. And while those low periods of volatility are going on, we want to check for downside stochastic momentum crosses, which we do see happen right here and again right here. Now, of course, in hindsight, the second one was a little bit of a better timer, but ultimately both of these were completely fine. And well, we can see from there another 16% move to the downside over the next week. And volatility explodes on that downside move, going well above 70 percentile all the way to 91 percentile right here, which was very close to the low. And again, taking profit on that move right there, or on that tick right there, that is a good trading decision. We want to realize the profit when we have a high probability indication in our hands. Yes, things go on for more than that. That's okay. We can reposition later. The market's not going anywhere. We can, of course, find another trade. We have a system. We don't need to be relying on just one trade here or there. That is the purpose of following something like this, an actual rule set. It's another great example right here, actually. So I'd like to quickly do it as well, where price bounces back up and we do see the trend continues to the downside. Volatility once again comes into a full-on contraction here. And from there, it's time to be looking for stochastic momentum crosses to the downside, which we get a beautiful one happening right here alongside that low volatility. And what do you know? Not so long later, we do see yet another almost 24% move. And again, volatility explodes on this tick right here, goes all the way to 100 percentile. Realizing some on this first move down is a good trading decision, because how often do you let go of profits? But if we pay attention to our tools, we can, of course, be a little bit more consistent with that. And this is a great tool for that purpose. Yes, things do go on for more than that, but ultimately you can take partials as well, which is something that we'll cover later on within this program. So now that we have the base of this system, you basically have like your stock car now. Now we're gonna go ahead and add in a few other little bells and whistles that you can use to optimize towards your own preferences. You can really start to make this system your own. So I'll see you in the PMARP lesson, which is where we will go over a tool that is specifically designed for more short-term scalping type of traders. I'll see you in there. Imagine this situation. You're in a trade, it's going in your direction, you're seeing this green number on your screen continue to grow and grow and grow, and you're thinking to yourself, what should I do? When should I close? When close? The PMARP gives you a statistical understanding of when it is a good time to be closing that trade, so you can no longer have to deal with this sort of uncertainty of, am I closing too soon? Am I closing too late? Am I going to give it all up? As we've all experienced, you know, that time when trades go in your favor and then it goes against you. Well, if we would have been using the PMARP, it would have been giving us a likely good area to be getting out specifically for the purpose of scalping. So in this lesson, we're going to learn what the PMARP is, how to set it up, and then how to apply it for the purpose of scalping. I'll see you in there. So what is the PMARP? The PMARP is an indicator that I actually created myself, or at least it was my idea. My friend coded it, and it is the price moving average percentile indicator. What does that mean in English, or what does it do? Well, it measures the deviation that price is away from whatever moving average you're looking at, and then ranks that into a percentile format, as we went over earlier, which can then let you know if this is statistically very far away from that moving average, and thus likely a good time to perhaps think about taking profit or not. So in other words, you'll have an understanding of when is a good time to be taking profit based off of statistics rather than just guessing when should I close. So let's go over where to find the PMARP and then how to format it. First things first, as always, we will go over here to the Indicators, Metrics, and Strategies tab on TradingView. You can also just hit your backspace key, which will bring up this pane here. From there, simply type in PMARP, and it will be the one that is created by the caretaker, my good friend, and well, I guess we're colleagues. We've been colleagues for a while now, and all you need to do is just simply click it, and it will show up on your bottom end of your screen. From there, we need to format it. So go to the top left-hand side and find the Settings tab. Simply press that, which will bring up the Inputs tab here. Now it should come like this in default, but if it is not, for whatever reason, then we need to do some formatting. First things first, indicator. We want the price moving average ratio percentile. Very important. If you just do just the ratio, it's going to be a completely different thing. Also a value, but not in the context of this particular video. PMAR length is going to be 20. The MA type, we're going to use a VWMA here. I should let you know in a future video, we will go over different sort of MA types you can use for different purposes, but this is going to be like the jack of all trades entry right here. From there, the next important part is the look back. 350 is what we're going to go with. Again, there are different settings for that we'll go over later. And then actually the one thing that we will change here is a signal MA. We're going to change that to an EMA, and we're going to put that down to a 7. All right, once we've done all that, we are good to go. And our indicator should look something like this. Or if you're on current price action, something like this. So now that you have it set up, in the next video, we're going to learn how to use it and apply it for the purpose of scalping. Now that we've gone over the proper settings for the PMARP, let's go over how to use it as a scalping indicator within this overall system that we've created in the prior modules. So let's go back to this example here. Bitcoin is in an uptrend. How do we know that? Because there is a 21 and 55 EMA cross right here. And then of course the 9 starts to lead, which means that we have a trend in motion. From there, we look for potential entries to the upside. We are going to use BBWP again to time the entry, as well as stochastic. We don't need to go over this too much again, but this would be an example of an entry right here. And from there, we can then reference the PMARP to understand when would be a good time to take the money and run if we just want to kind of jump in and out of this trend and not really hold anything for too long. So this is really dependent upon a specific preference here. I actually count myself among these people, but in this case, I generally find that when the PMARP goes above 75 percentile with these default settings here, that's a good time to take some profits, because as you'll see in this, actually this example works perfectly. We can see that from that entry to that read, we capture the overwhelming majority of this move. From there, we give ourselves a chance now, because we have taken profit, we can take advantage of another opportunity as soon as it comes about, which is not too long after that. Again, same low volatility, same uptrend. Stochastic momentum turns up right here. And what do you know? Soon after that, we see another, well, actually this one doesn't get quite up to 75 percentile. Again, preference call, it gets up quite high to 72. You could have taken profit right here. It's a preference call, it's up to you. But let's say that you do, and then you reposition yourself again, right here. We get the same damn thing yet again on this continuation move. Actually, several times over, it looks like, with another really good example in this area right here. So I'll go over this one as well. Boom. And then of course we get another example of an exit right here. Again, anything above 75 percentile, take it off the table. This means, however, you will miss those absolutely monstrous moves that cryptos can sometimes do. This is a preference call. There's no right or wrong. I find personally that taking profits early and often is better, but if you're a long-term investor, this is not going to be for you, obviously. So going on from there, we do see a couple more examples over here. Again, ones that we referenced earlier. Entry right there, upside crown cross. We see BBWP low, stochastic momentum turning up, all simultaneously. And from there, we would have scalped this sort of move right here, which means that we would have missed all of this. So that is what you do give up. And I do want to give you the full information on this, because if you are going to trade like this and you are the type of person who feels FOMO, for example, it's not going to be for you. Or I should say that you should use a different tool or use different settings. You could use much more conservative settings, let's say, with a much higher look back and a different MA type, and RMA would be good for this purpose. And that will be a little bit more accurate towards the top side of this trend. In these cases, volatility is going to be your friend and going to be a lot more accurate in that particular description. Let's go over another example, another set right here. Again, low volatility. We see stochastic momentum actually crossing up alongside of that. So this is like really riding the trend. This is like getting on a surfboard and just riding the waves. And we take profit right here. It's above 75 percentile. Again, boom. Okay, do we get another entry soon after that? Yes, we do. We see more potential. There's our upside cross. Boom, takes its time. And then we get our take profit over here. Again, it's not gonna be perfect, but we're scalping in this case. We just want to get in and out. That's the only priority here. From there, do we see any more examples? Not the picture perfect ones that we want to be looking for, actually. So that means that we don't have a high probability setup until actually a couple days later on this time frame, the hourly, where we get some upside crosses here alongside volatility right here. And we get an opportunity to take profit relatively soon after that. In this case, we get a big explosive move right here, which again, this is why I personally prefer to take profits on a move like this, because, well, we do have the advantage of seeing further on into the future, and it does dump down after that. But two, we get at the top of this move. That's good bang for buck in my experience. So again, PMARP is for scalpers who want to jump in and out in a relatively fast manner. Understand it's not going to be perfect, but we're looking to sort of surf that trend and not look for like the moonshot. That's not what this is for. Now you know how to use the PMARP and surf those trends. In the next video, I want to go over a strategy that you can use to maximize the value both in time and nominal of using strategies like this and trading while also maximizing the holding value of your cryptocurrencies. I'll see you in there. So now I want to share with you a strategy that can both maximize your trading and also your long-term holding within the context of cryptocurrency. So we've gone over a lot of strategies on how you can sort of get in and out of trades and do all that cool stuff. But of course, long-term, buying and holding is a very viable strategy, and it is very difficult to outperform buy and hold in cryptocurrencies when assets can go hundreds of percents in a very short amount of time. So what method can we use to capture both of these simultaneously is actually something very specific to crypto. One of the reasons why we partnered with the exchanges that we did at the beginning of this program is because they offer something very, very important, which are inverse perpetual contracts. Inverse perpetual contracts are futures contracts that allow you to use the underlying asset that you are trading as collateral to put on leveraged trades. In other words, that means you can trade Bitcoin on leverage and use Bitcoin and hold Bitcoin as that collateral to put on those leveraged trades. So you are not just making money from the trades that you close at a profit, but also just from holding the underlying asset, assuming, of course, it continues to go up. That is all to say that the active trading portion of your portfolio should be relatively small compared to your long-term portfolio, or at least that's what I would suggest. Trading realistically should be no more than 10% of your portfolio if you're not doing this as a professional endeavor. With that said, I want to caution against using very high leverage. In my experience, it's never wise to go over anything above 5 times leverage. And what we're going to go over in the next module is a method of risk management that lets you know exactly when to get out of your trade, because there is a high likelihood it is not going to continue in the same direction for you, and things are only going to get worse. It's only down from here as far as the profit and loss statement goes. So I'll see you in there. Wrecked is what we all want to avoid when it comes to trading. And it doesn't matter how much profits you might be making or might be showing on paper if you multiply by 0, which is, of course, getting liquidated or getting wrecked, as we like to say in cryptocurrency. So in this lesson, I want to go over a tool for what we call risk management to avoid that particular scenario ever happening. When we use proper risk management, we can ensure that our losses are limited. And the ideal scenario here with risk management is that we want to have an objective signal that lets us know that if this condition is met, if this condition is present, then it is better to be taking the loss now on the trade rather than waiting, because it will only get worse from here. So with that said, I'm going to show you a tool that you can use, and let's get into it. So now I want to introduce you to a tool that you can apply to your charts that will let you know when it is wise to get out of the trade and just take the loss here. Because again, if the loss is going to get worse, there's no point in sticking around. First things first, go to your indicators, metrics and strategies tab here, or hit backspace and type in all one word, LUXALGO space support. We're looking for this one right here. It has almost 20,000 likes on TradingView, and we simply click it. And you might even want to add it to your favorites as well. It will show up here at the top left-hand corner as far as its settings indications go, and it will populate on your chart like this. Now, I want to give you an example, a quick example, as I think that this is rather self-explanatory of how to use this. So in this case, let's apply our system here. Again, we have the overall uptrend with the crown cross moving averages. We see an entry right here. And so after that entry happens on this green vertical bar, the way that we're going to use this is we look at the most recent blue line that happened before our entry, and we use that as a risk management point. Now, something very specific with this that is not intuitive perhaps is that if price tests or just trades down towards this blue line but does not close below this blue line, that's completely fine. That's completely okay. We stay in the trade. In this case, you can see it is tested many times after the entry. Once, twice, 3 times, 4 times, 5 times. That's all good. As long as there are no body closures below this level here, we stay in the trade. And in this case, we can see, keeps us safe the whole way, and it's a nice trendy movement. So now let's go over an example where I think will perfectly illustrate why it is important to take the loss now rather than later. It happens right here. We can see, again, an upside crown cross, so we start to look for longs. Volatility starts to go very low after that, and we see a stochastic momentum cross to the upside in this vicinity right here. If we would have taken this long, well, let's see what would happen with this specific blue line or support as our risk management. We can see very soon after that, price starts closing below. So we see actual bodies close below the blue line. That happens for the first time right here. That would have been a damn good time to have taken the loss, because what happens after that? Price absolutely craters down for another 11.5%. And of course, I should also add that we can apply this same methodology to short trades, to downside trades, just by using, instead of the blue line, the red line, the most relevant red line before that. So here we have a really good example of a short trade where we should have taken the loss early. In this case, we have a downside crown cross setup. There's actually several, if you were scalping this one. I'm sure if we had the PMERP up, we would have taken profit a few times on this one, maybe even taken profit on the low side of this move right here and avoided all of this. But assuming we entered on this second setup here, again, low volatility, downside cross, downside moving averages, we would have been using this red line as our risk management. And as you can see, price goes in our favor a little bit of time, and I'm sure that we've all had that experience where trade's going in your favor. Let's hold on to it. Let's start to look out Ferraris and Lambos online and figure out which color we're going to pick out. And then very quickly after that, price comes back up, closes above the red line right here on this candle. And from there, it dances around a little bit, and that's not the trade we want to be holding. And in fact, here's an even better example. Because we took the loss here, theoretically, it allows us the optionality to jump into another opportunity when we so see it. And what do you know? What happens right here? We get an upside cross soon after that. We see low volatility right here, and yet another upside stochastic momentum cross right here. And we get to ride this trade instead of get absolutely destroyed by this trade. That is what it is to be a trader. Take the loss when it's time to take the loss, so that you give yourself the opportunity to take advantage of another potential opportunity. So now that we know now how to avoid getting wrecked, we're going to go over into the next lesson where we learn about Fibonacci's and how to get another sort of tool to time local highs and local lows. I'll see you in there. Have you ever wondered why you're attracted to the person that you're just attracted to? Why are they beautiful to you? Whether it be a guy or a girl or a they or a them, it doesn't really matter. It is 2024 after all. Have you ever wondered what defines like the perfect teeth ratio, or the petals that you see in a flower, or the way that like a seashell is arrayed? All of these things come back to what is known as the Fibonacci ratio. If you're thinking in terms of like the Vitruvian man, that is what I have pictured right here. It's that ratio that for whatever reason shows up again and again naturally in nature and is essentially a marker of health, beauty, and just the perfect ratio. And it also works in trading as well, and it is a part of our overall system, as it can add an additional confluence to where higher lows or lower highs within an overall trend are likely to come around, and what that particular level according to the Fibonacci ratio means. So with that said, we're going to add it into the overall system to make it more robust, and we're going to go into the settings video next. So I'll see you there. So now let's go into the most important Fibonacci ratios when it comes to trading. So first things first, we need to find where our Fibonacci tool is. If you look at my screen here on the left-hand side, there will be in the third category here, the Fibonacci retracement tool. If it's not there yet, just press the right arrow on it and you should be able to find it in this list of different indicators. Once you have that, again, this Fibonacci retracement tool right here, which you could actually also use Alt+F, we can bring it up and let's just draw a random one on the chart. Doesn't matter where we draw it right now, we're just doing the settings. So from there, we are going to select that drawing and we're going to go into the window that just popped up here and select settings. From the settings, we are going to format specifically which Fibonacci's we want to show on the chart so it's not a million different fibs, you know, going here, there, and everywhere. In this case, I actually already have mine formatted in the way that I want, and I would just suggest that you copy very specifically what I'm about to read off here. Starting with 0, 382, I'm going to have this one as yellow. The 618, I'm going to have this as red. The 0.5, I'm going to have this as green, and the 786 I will have as cyan. Those are the ones that we're going to be most concerned with. All of the other ones you can tick off, which I will actually do right now as well, as they might just get in the way of our beautiful Fibonacci picture here. So once we have that, we have the most important fibs. Now, before we get into the next video, I want to explain the importance of these different numbers. The 382 is what we will refer to as the shallow fib. This is where we expect more strong trends to come back to in order to put in that higher low or lower high. The 50% level right here is actually not a fib, although it is a common area of interest where you might find the same thing coming in as well, but it doesn't really imply strength nor weakness. It's neutral, as 50% would imply. The 618, however, is a more deep retracement. It's also known as the golden pocket or the golden ratio. This is actually what people typically refer to as Fibonacci's in nature, as this is kind of what makes beautiful people beautiful, which I know nothing about. And then of course we have the 786, which is a very deep retracement. And the 786 is going to be a level that is very much relevant, but if it is hit, it's an indication that our current trend is weakening in strength. So we don't want to maybe treat that one the same way as the other numbers that we outlaid before that. Now that we have all that set, we're going to go into actually how to draw these Fibonacci's properly and then fit it within the overall system. I'll see you there. So now that we have the correct Fibonacci settings, let's find out how to properly anchor the two different points on the Fibonacci's. There's a very specific reason why this program was outlined in the way that it was outlined. We had to go over local lows and local highs first in order for this to make sense in particular. Now, recalling back to our local lows and local highs, we are going to fit and anchor a Fibonacci between a local low and local high very specifically. So the key here when drawing Fibonacci's is that you anchor it in the same direction as the trend. So an uptrend, you start with the anchor on the low and you end on the high. So for example, we have a low and a high right here. So that means we're going to anchor the bottom there, we start there and we go in the same direction of the trend and we end high, start low and end high. And in this case, this is a move that, well, pretty much just shot right through on both sides, although you do see a bit of a base at the 382 here. And of course, this will happen from time to time. But ultimately, this is the methodology that is best used. Now let's do a downtrend. And of course, in a downtrend, because it is going down, we start high and we end low. And we can see over here that there is a nice downtrend. So we're going to anchor from, or first let me draw off the major high that we're going off of right here. Major low that will end here. And of course, there's highs and lows in between this as well. And those would be perfectly valid to go over to if you wanted to specifically look at those pieces of price action. But in this case, we're going to look at the greater picture, if you will. We're going to start high, we're going to end low. And then I'm going to expand it out over here so you can see how that operated from there. In this particular case, we can see that once this low was in, price action pulled back and it based twice at the 382, the shallow fib. Those first two initial tests were rejected and pushed back. These could have been potentially tradable events if you're looking to scalp them, or if you're looking to trend trade, perhaps those could have been decent areas for, well, jumping in on a lower high. Then you can see actually the bull trap of 2022, where it trades all the way up to the 50% level, rejection, and down. Now, I will say, while the 50% level is not an indication of strength or weakness itself, the side of the 50% level that price action is on is. As long as price is below the 50% level, we should be thinking that this current trend can break down faster than it cannot. Essentially, it's in danger of breaking down in this case, or in danger of continuation. Same thing for the upside as well. And you can see these Fibonacci's correlate with all other portions of this whole move as well. We see the 618 getting this consolidation high right here, the 786 getting this right here. It doesn't need to be exactly picture perfect, by the way, but it should be about right. Now, I want to address another nuance with this too before we move on, in that should you be using the literal wick high of that trend or the highest closing price of that trend? Both are valid. The thing is that you should be consistent. If you are using wicks, use wicks on both sides, meaning that the high and the low should be the highest wick and the lowest wick. And if you're using closures, same thing. And if you're using that, then it will be consistent going onwards and forwards. I would say if you're more of a scalping type and you're looking to maybe trade closer towards the major higher or the ultimate higher, the ultimate low, the wick is going to be a better venue for that. But if you're looking for more objective indications, then going with the closure is going to be better, as that is going to be more consistent over time. Let's go over a couple more examples as well, and then we'll move on. Again, we have another example right here where we see a bit of a downtrend starting with this high, ending with this low. So we start high, we finish low, and we can pull it through. And as you can see, if I pull it through a little bit more, we can see that price action bases upon this whole structure here the whole way through. Let's do one more to the upside as well, and then we'll call it a day. Okay, let's start from this low here. We'll end at this high here. And again, you could draw, from this low here to this high here, this low here to this high here. All these are valid. It's just relevant towards that piece of price action, but we're specifically focusing on this one to this one. And again, I'm going to pull it all the way through, and you're going to see that these actually, while this one was technically anchored on this low, if I pull it through, you can see that it actually gets respected later on by price. This first move down after the high bases at the 382. Once the 382 is broken, trades towards the 50%. First wick rejects, comes back down, closes below, trades towards the 618. Same thing. It comes all the way down to the 786 and bases there. And you can see once it breaks back above later on, it respects these on the other side yet again. So the Fibonacci's that you anchor on big pieces of price action like this, they will actually be relevant later on in the future. So now that we've gone over where to anchor these Fibonacci's and also a few nuances with this, we're going to go into the next video where we anchor the Fibonacci's so that they correlate specifically with the likelihood of lower highs or higher lows to come in around within the overall system. I'll see you there. So let's put the Fibonacci to work in our system. Now, the role of the Fibonacci is to give us another tool to get a likely lower high in the case of a downtrend or a higher low in the case of an uptrend. So here we have a good example of how to use this in the case of a downtrend. We're going to zero in on this price action here, starting with this high and this low. We're going to draw our Fibonacci again from high to low because this is a downtrend. We have lower lows and lower highs, and we're going to extend it through. So as you can see, the crown cross remains to the downside the whole way through. And while there are some pretty violent rallies throughout this overall down move, these ultimately resolve in lower highs. Now, if you notice something very specifically, it's that these lower highs all come around the major fibs. We can see this first one comes around the 618. And even there, you will notice that the crown cross remains positioned to the downside this whole way through. So it just overshoots. And this lets you know, hey, if you're looking to still play this trend, this is where a good high quality lower high will come in around. And in this case, it certainly does, as it continues down, 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 as these moving averages continue to remain in the downside posture. Now from there, we see another couple lower highs right here and right here, which are simply just tests of the 382, the shallow fib. If you were scalping these, for example, these would have been in and out moves, no problem. And then of course, later on, the big one, the 50% level comes in yet again. We can see price pops back up. The moving averages even cross back up into a bit of a trap, which is fine. But as long as it's below the 50% level, it's still what we would consider weak, or, more likely to break down. As long as price is below the 50%, downside more likely. When price is above the 50% level, upside more likely. And in this case, downside was certainly more likely after that for an actual breakdown. And when I say more likely, I mean for an actual trending move breakdown, as you could just say the same thing over here with the 618. Why not that one? Well, as you can see, this was not a continuation move. It wasn't a continuation move until you got the rejection below the 50% level. And from there, big move to the downside. So that's a downtrend. Let's now find an uptrend. So here we have the beginnings of an uptrend. If we anchor from this low here, the bear trap of 2021 summer, to that first major high in September of 2021, we see the beginnings of that first uptrend. So we're going to anchor our low here, and we're going to anchor our high here, and then we're going to extend it out so that we can pull it through and look at it for the next segment of price action. You can see once this high was in, price comes down violently to the 382 and bounces immediately. A very hefty bounce, I should add at that. Nearly 15% bounce over the next week and a half. From there, price comes back down, tests the 50% level, and this is the big one. Again, the 50% level, as long as price is above that on the, what I would call this as a dominant trend, well, it's in a powerful position. And in this case, it marched on to new all-time highs. And then we get to repeat the process yet again. So now that we have the final piece of edge to our system, it's time to start to explore our own preferences using all of these different moving parts and fitting them into a testable hypothesis that then we can generate strategy statistics from and understand if this is going to be relevant to our interests or not. So up until this point, we've been building this car. It's a nice stock car. It works, it's good, but it's time now to customize this car and make it into our own, our very own, because naturally, different people are going to have different sort of preferences. Some people are more long-term trend trading types. Some people are less so and more so short-term scalping trading types. And then there's the whole spectrum in between that as well. And you will naturally find your own trading personality by trying out different types. And the key important thing to pay attention to here is that the type of trading that you are most easily to adhere to and be consistent with is the one for you. Remember, trading over a long period of time is about consistency in alignment with statistics that are geared towards your favor, essentially having that edge in your favor. So we need to have some sort of an edge, some sort of a strategy that is easy enough for us to play out without fighting that internal battle and wanting to do something that we're not supposed to do off plan. So in the next video, I want to go ahead and define some terms here so that we're all on the same page as to what we're talking about with regards to long-term and short-term trading. So before we go on, we should define what long-term and short-term mean within the context of trading, which really should be translated into trend trading versus scalping. Trend trading is where you're looking to capture the majority of an overall move. I think the best example here would be to talk about a bull market or a bear market, and that would be recognizing that the trend on a very high term time frame, like a weekly time frame, has switched around to the downside or the upside. And in the case of scalping, we're talking about generally shorter term minded people. Shorter term minded people versus longer term minded people, these are both completely valid. But for scalpers, you generally want to get in or out. You could be scalping a 5-minute time frame, you could be scalping a daily time frame. The difference is the mentality. So with that said, we're going to jump into the long-term preferences or trend trading preferences, and I'll see you there. Now we're going to go over some ways that you can personalize this to a more long-term minded person. Now, of course, your preferences are your own, and these are really just ideas that I want to be, pushing you towards to explore on your own, as that will naturally lead you to your own unique system. So in this case, if you are more long-term minded, you're likely going to be more in alignment with the trend trading. So what's going to be most relevant to you is looking at the moving averages and looking at higher term timeframes. Or if you're, looking to swing trade, you could apply this to lower term timeframes as well. In these cases, I do find that looking at the moving averages, the crown cross in the upside or downside position are good long-term interest points for initiating trades. Now, the BBWP will help time those entries for you, but here are some things you might want to consider. Now, with the moving averages themselves, you can actually start to change around and raise the period of the moving averages so that they're a little bit less responsive, meaning that they'll keep you in trades for a little bit longer. In this case, I would suggest using a 34 length instead of the 21, and then instead of the 55, you could use an 89. These are very specific Fibonacci numbers as well, and as you can see, they're going to keep you in long trades more often than not, in this case, as we do see an uptrend emerge. So that would be the first thing to sort of consider. Now, of course, you can play around with different numbers as well. Completely fine. You might even go all the way up to the next major Fibonacci numbers. But from there, another thing to consider is that you might change these settings on the BBWP. You might have a longer length. You might go to 20. Or the look back, you might want to incorporate more data so it's less sensitive. So maybe you put that up to 350. These are all completely valid, and it will make the overall system more or less sensitive to short-term changes. And you'll notice that the general theme here is that we're raising the number of the inputs. Now, it could also be that you add another indicator. You can play around with other indicators as well. That's completely fine. If you want to use a different momentum oscillator instead of stochastic, because that's maybe more geared towards relatively short-term moves, perhaps you play around with an RSI. These sort of things are completely fine. This is really where I want you to go ahead and try new things. You can fit those different indicators into the mold of this, and naturally, it'll start to make sense towards your own preferences. Now, also, if you are more, let's say, long-term minded, but you still want to scalp a little bit as well, perhaps you do use a PMARP, but in the same vein as we looked at on this BBWP and moving averages, perhaps we employ a much less sensitive setting scheme here. Instead of a VWMA type, we go for an RMA. Instead of a 20 length PMAR, perhaps we could go for a 55. And perhaps instead of a 350 look back, we could go to a 500 look back, just incorporating more data so that these small changes are less and less noticeable, thus keeping us in trades for longer. Again, there's no right or wrong here. And I really want to emphasize that this is your chance to play around and personalize things, because you naturally will find things that are probably completely new that I don't know anything about. And that's really where the magic happens, because the system becomes your own then. And from there, well, you're going to iterate and iterate and iterate. And at some point, you're not even going to recognize it anymore from my base. And you're going to have your own personal trading blueprint, which is completely unique to you. In the next video, we're going to go over some more short-term minded ideas and changes that you might want to consider. I'll see you there. So now that we've gone over more trend trading preferences, now let's get into what you might consider if you are more short-term minded and a scalper, let's say. So first things first, we will employ just kind of the opposite but equal ideology as what we went over in the prior video, which is we will generally apply lower settings compared to the base format. Now, in terms of moving averages, you might want to play around with an 18 and a 9. In this case, we do see that the 9 is already there, so I would change the length of the yellow one to 18, and I'd basically just be going off of these two moving averages. Maybe I even put in a 5 as my shortest period, and I use that in place of the crown cross. Completely valid. And as you'll see, there's going to be a lot more of dancing around of these moving averages, which does provide more general opportunities to kind of get in and out of things. But of course, from there, we can employ different settings on our indicators. For the BBWP, I would strongly suggest, if you're more short-term minded, instead of a 252 look back, try a 100 look back. It's going to be a lot less data, but again, that's going to give a lot more opportunities, which will be relevant towards the look back, but at the same time, allow you to kind of get in and out and scalp a little bit faster with your scalping tool, which can be the stochastic or the PMARP, or you can use an RSI. Again, this is your chance to really personalize the system. But for the PMARP, for example, here's something you might want to consider. Instead of using an RMA type, we could use an EMA. We could use a 9 PMAR length, for example. And we could put our look back from 350 to 100, which is going to make this very sensitive to short-term changes. So with these sort of small changes in mind, you are going to get a lot more signals. You're going to be a lot more active, which might require a lot more time at the computer. Again, that's a preference thing. You might not be that person. You might want to be the person who, kind of gets into a trade and rides that for days or weeks or even months in some cases. Or you might not be. You might be a scalper. It's completely fine. At the end of the day, you can fit in any sort of other indicator into this general blueprint and make that work for you as well. So these are really just some things for you to consider and play around with as you get to know yourself as a trader and what you are able to be most adherent to as you work with your own personality. That is the most important thing here. So again, you got the car, you have the keys. Now it's your time to go ahead and customize it and make it really your own. So I would really, really encourage you to have fun with this and try different unique things that, maybe might even make most sense right off the get-go, because in the next lesson, we're going to learn how to test these and figure out if they actually work or not. So now that you have a system, it is time to backtest that system and find out if it actually works. With that, we will derive some strategy statistics for that system, which you can then decide how to manipulate for. So we're going to go through a few different strategies together, one long, one short, and then I'm going to give you a strategy that's a little bit different, just kind of showcase how you can really start to manipulate these inputs and make it completely your own. So we'll start off there, and I'll see you in the next one. So here we are on our Google document, which is what we're going to be using to fill out the trade system checklist. You are 100% free and encouraged to copy this on your own as well. And we're simply just going to fill it out with all of these 7 different considerations that we will have at minimum for this strategy. So we're going to have, of course, our time frame, whether we're going long or short. What are we going to be using for our main source of edge? What is going to define an entry? What is going to define an exit? And what other considerations we might be having for this, as well as risk management. Once we have all of those 7 at minimum, we can start to actually test this strategy. So think of this in terms of like the scientific method as the hypothesis. We're generating a hypothesis. We have a good idea of how price moves, how markets work, but now we need to figure out exactly and precisely if this strategy on a very specific time frame with very specific inputs for very specific preferences is going to actually work. So I am going to create a strategy with you, and we're going to find out together if this works. And we're going to do that through first this trade system checklist, and then we're going to go ahead and back test this. All right. So first things first, what time frame are we going to be looking at? Well, 4-hour time frame is the one that we are going to be testing this particular strategy on. What side of the market are we going to be trading, long or short? Well, in this case, we're going to be long traders, feeling bullish. What will be used for the main source of edge? So what indicators are we using in this strategy overall? Well, one, as you likely know, we're almost always going to be using something for trend. That is indeed the most important and will really keep us safe on that general side of the market. In this case, we're going to be going with the crown cross. We want to see the 9 versus the 21 versus 55. We also are going to be using something for volatility. We're going to be using the BBWP. And then also we're going to be using the stochastic oscillator as our momentum oscillator. So we have trend, volatility, and momentum in this model. Because this is a trend trading strategy, I'm not going to be using the PMARP. I'm going to be using volatility actually to be taking profit for this strategy. At least that is how I intend to test it. So how will positions be entered? This condition, again, if all of these are present, we enter, and they need to be very, very objective, meaning that there should be zero ambiguity as to what constitutes an entry or an exit as well, or anything here. So first things first, we need to see that the crown cross has the upside posture. For trend, we're most interested in the 21 versus the 55. So the 21 EMA must be above the 55 EMA for us to have the green light for the next conditions. The next condition I want to see is that the BBWP value is less than 35. That is in our contraction zone, or usually where we can kind of expect that contraction zone. Then I want to see that the BBWP moving average is negative or having a negative slope. So it is essentially downwards postured, or if you're looking at the nominal value, it must be moving down from the prior close to the current close. If that condition is met, okay, green light again, BBWP MA, negative. And you know what we'll do in our testing? We'll actually show when this condition is present versus not present so that you can get a good understanding of how this might affect things. And it's really good filter actually for getting in on those higher lows or lower highs. And then last, we'll be looking at the stochastic oscillator. So we want to see the stochastic cross up. It must be up. That's it. If all four of these conditions are present, we enter. If they're not, we do not. And as you can see, all of these are very objective. The number is either there or not. That's it. If you have something other than this, or if you ever feel ambiguity, you've done goofed, you've done something wrong, and you've learned nothing from this program, which is okay. You can always go back and review the prior content. But this is really the priority here. No ambiguity. How will positions be exited? So profit taking. Well, in this case, I want to see the BBWP be above 80. And see, these numbers, once we have an actual working system, something that's viable by our own definition, we can start to, change around these numbers and see if something might be better, perhaps, might produce better results. Now, what will define a risk management parameter? So what, if present, would denote that this trade is unlikely to go in our favor. Thus, we should close it right now and take the loss because it's probably going to get even worse. It's better to take the loss while it's a smaller loss compared to a bigger loss. Of course, that is how we avoid getting wrecked on our account. That's how we avoid multiplying by zero. I want to say this again. If you're trading with leverage, a leverage liquidation level is in no way, shape, or form ever acceptable as a stop loss. Your stop loss must precede whatever liquidation level that you might have. Why is that? Because a leveraged liquidation will, one, actually cost you more because it's not going to be optimized in its positioning. Likely you could have closed that trade earlier and you'd have indication earlier that that trade wasn't going to work out before getting liquidated. And then two, if you do get liquidated, you actually pay what's called a liquidation fee on top of already taking a massive loss. Typically, exchanges are very generous in the way that they award themselves that liquidation fee. So save yourself at least that. So what defines a risk management parameter? We're going to use the Lux algo, in this case, support and resistance indicator that we showed earlier. And I do want to say at the outset that this indicator, while it is viable, it is okay, it's not going to be optimal. You can find other ways to manage risk. And we'll actually go over one. One of them is just having a stop loss by percentage built in there. So in this case, we want to see that the close, in order to denote a risk management event, that the close of price must be below the most recent red or blue line, whatever one correlates to below the entry. And then the last portion here is consideration. So here's where you can have fun with stuff and really start to manipulate sort of inputs. I will give you some ideas of stuff that I typically will put in here. So for considerations, you might have certain days that you want to trade. In general, for long strategies, especially under the 4 hour, if you omit trades on Thursday and Sunday, that's going to net you a higher net profit overall. Those days typically do not do well for long strategies. For short strategies, those days correlate to typically Monday and Tuesday. Those are the ones that you typically want to avoid. Sometimes Wednesday and sometimes even Friday as well, for certain strategy, at least that I've found. Also, another consideration, you might have what I like to call a higher time frame trend filter. So just like you want to trade with the trend on the time frame that you're on, in this case, the 4 hour, you might have a condition that not only do you want to see an uptrend on the 4 hour time frame, but your hit rate will be improved if the 4 hour and let's say the 12 hour or the daily time frame are also in uptrend. It's kind of like having a bit of a fail safe on that. It gives you more wiggle room for that trend to likely be legitimate. And then we're going to also potentially have a stop loss or take profit just by percentage. So we might say, hey, 2%, if it gets 2% above my entry, I'm taking my profits, taking the money to run. Or if it gets 2% below my entry, I'm taking the loss. Let's just get out of here. So this is the system trade checklist. Now we're going to go back test this particular strategy and find out if it's viable or not. So now that we have our system hypothesis, it is time to go ahead and backtest this on the chart, which we will then record the results on a Google Sheets. Now, if you have other backtesting or journaling sort of services, you can use that as well. The most important thing is that we can derive the win rate and the average returns from this, as well as time in trades. If you can get that, you're good to go. Our system strategy here is that we want to see when the BBWP is below 35 percentile, and we will take profit when it is above 80. So I just want to mark these areas off on my BBWP just so that we can very easily see this, as well as the other conditions, which of course we have our crown cross, the yellow 21 and the green 55, and then we have the stochastic oscillator. And of course we do have, for the risk management, the Lux algo support and resistance levels that we showed in the earlier lessons. Okay, so now that I have this already, we can see that there is a crown cross the upside right here, 21 crosses the upside of the 55. And from there, we then scan for when the BBWP condition is met, which we do see soon after that, as we can see it is well below that lower green line representing the 35 percentile level. And we do see that the stochastic oscillator will simultaneously cross the upside right here, whilst all those other conditions are met. In this case, where is our prior risk management? Well, the most recent blue line, or just line coming in from the Lux algo, that is below our entry, would be right here. So on a closing basis, we need to see price close below there. It can test there, it can wick below there, that's fine, just no closures below there. So we have our entry. We're going to record that on whatever your recording service is. In this case, I'm going to be using a Google Sheet that I filled out myself. I'm not a Google Sheet wizard or an Excel wizard, so you can probably find better ways to do this, but we're going to record the entry, which was 42,626. Okay, 42,626. Beautiful. Where is the exit? Well, the exit is where either the risk management level is hit or where we see BBWP above 80 percentile, which happens right here a little bit later. And you can see price action is 45,447 at that point. 45,447, and we have about a 6.62% return on this trade. It's a win, so I record a win right there. I should get rid of these. These were for a prior strategy. Time on the win, so I want to record the amount of time that it took from entry to exit, and in this case, it is 10 days. It's quite some time, but fair enough. I'm going to put days here. And then I want to differentiate the nominal value and the win average percent as well by nominal and percentage. So we're going to start to record those up later and average those up later. Let's go find the next example. I'm scanning more. We still see the crown cross the upside. I see that BBWP goes below the 35 percentile right there. Okay, so check one, check two. Now we need to see the BBWP stay below there. Well, it has a negative slope. Again, negative slope means that the white moving average has a downwards angle, and that happens right here. And I believe, yes, the stochastic oscillator is positioned to the upside at that point. All right, so there's our entry, and where's our most recent line? Right here. So there's our risk management. And again, you can see this one tests it many times. That's completely fine. Just don't want to see closures below. So this is our entry, 51,842. All right, 51,842. 842. Where's our exit? Well, we need to see BBWP get above 80 percentile, and that happens right here on a closing basis. And yes, okay, confirmed. And that is at a closing price of 54496. 54496. $2,600 trade again. This one getting a little bit over 5% gain. It is another win, so I record it like that. How long did this one take? It is 8 days and 12 hours. So let's just call that 8.5 days. 8.5. All right, let's find the next one. Okay, here's another good example. Again, crown crossed the upside the whole way through, so that condition is met. BBWP goes below the 35 percentile read right here. The moving average is certainly having a negative slope there as well. So while those conditions are present, we see right there, we can see the stochastic momentum condition is not present, however. So let's move that over to where it is and see if the other ones are still present. Yes, moving average condition is present. BBWP condition is present. And moving average on the BBWP condition is also present. So enter, and well, where's our last risk management? So in this case, this is where I do think that understanding how to define highs and lows is very important, because realistically it should be right here. But if you're going off of the Lux algo, you'd pick this one right here. It's the most recent one that is below the entry. That would be pretty far away, so I probably wouldn't want to wait that long to figure out if this one's going to be a winner or loser. Anyways, we'd enter here 62,200. 62,200. All right, we can see that our take profit metric is hit right here. BBWP closes above 80. Okay, closing price is 66,515. 66,515. Whoops. Maybe it's good if you spell that right too. Okay, this one almost a 7% gainer. Nice. And again, I want you to think in terms of if you're doing this with leverage, it's not just a 6.94% gain. If you're using 10 times your account's equity, which probably wouldn't recommend, to be honest, that would be a 69% gainer. Again, leverage amplifies in both ways. You really don't need that much. What you need is maybe a very small amount plus consistency over time. We're not looking to make $1 million all in one day. And here we can see that this one from beginning to end, using my measuring tool on TradingView, takes one full day. Okay, so you've got a good idea now of how to record these trades. I'm gonna go ahead and fill out the rest of these 10 by myself, and I'll get back to you once we're done with that. Before we get into this one, I do want to say that you probably noticed that this is pretty time intensive and quite tedious, actually, and I agree, which is why I've actually been in development with a very competent developer, or coder, I guess I should say, to create a tool that essentially just does this for you, and you can, input basically whatever sort of strategy that you might be considering, and it will spit out the results just like that. And we'll actually go over that a little bit later. And first things first, though, I have finally finished the 10 trades here. Now, I do want to say at the outset, would I say that a strategy is viable just based off of 10 trades? The answer is hell no, or never in a million years, never in your wildest dreams. But for example's sake, this is the ancient way of doing things. So first things first, what do we want to pay attention to? The win rate. Out of these 10 trades, 7 were winners. So we could deduce about a 70% strike rate. Again, for 10 trades, probably not enough. We want to be looking at years and years and years of history. Hundreds, thousands of trades, the more the better. How long did the winning trades take to play out on average? Just under 5 days. So we can look at that information as, if I'm entering a trade with this strategy, I can expect to be in this trade for a while. And then how long did it take on average for the losing trades to play out? 2.5 days. So what can we deduce from that? Well, at the longer that time goes on, after 2.5 days, the more and more this is likely to be a winner. So we could say that the more that time goes on, perhaps we think of, moving up our stop loss, or just maybe getting more aggressive with things. That would be okay to do, because we can see from this, or at least this very limited piece of data, that that is what would be implied. Moving on from there, we go into the win P&L, just nominal value. In my experience, this is really actually not that valuable. Neither is the loss P&L nominal values. And this is just the amount on average that you lose per trade. The reason why is because Bitcoin is an asset, or cryptos in general, can travel such amazing degrees that, of course, your P&Ls are going to be bigger in nominal terms when Bitcoin's trading at $3,000 than when it's trading at $30,000 or $60,000, for example. So it's better to look at things by percentage, which is what these two categories are for right here. So this would be the average return for the winning trades, which actually that is not correct right there, nor is that. And so it would be about 5% for the winning trades on this data set. That means if you just belong to one Bitcoin and you open and close, you'd expect about 5% on average. Now, for the losing trades, it lost on average about 4% per losing trade. So think of it this way. Overall, you have probabilities in your favor in terms of win rate, and then your win percentage is greater than your loss percentage. So this is a viable, very likely a viable template, as we'll go into. Now, what I will say with this is that any sort of manipulation to increase those numbers is going to have massive implications on your actual P&Ls. And of course, if you use leverage, even a very small amount, and I would never suggest using anything significant, not over 3x. Personally speaking, of course, I'm not your dad, but that would just be what I would do. Anyways, that can multiply those numbers very quickly. Think about it this way. If you can expect on average a winning trade to return 5% and you're leveraging that 10x, I would not suggest that, but know that people out there might be a little more aggressive than myself. That would be 50%. That's a lot. If you can do that consistently over time, where you'll get hundreds and hundreds of trades, over the course of a year, that will add up to a lot. So let's go over here to TradingView now, and I will show you my tool that will essentially spit out the results for this particular strategy. And as you can see, over the last 137 trades, which runs us back the last few years, or the last couple years, there was just over a 60% win rate for this. So the win rate, once we started to look at more trades, did go down. However, when we go into the performance summary, we can see that the average winning trade returned not 5%, but over 8%. And the average losing trade returned or lost 7.5%. Now, I want to show you with this tool a few things that we could potentially do to increase these results right off the get-go, or at least test. So I'm going to go into my tool right here, and I will go through a few things that we kind of hinted at earlier on the strategy checklist with regards to manipulating the take profit or stop loss by percentage. So in this case, I am going to try a maximum stop loss of, instead of nothing, I will put, let's say 5% there. Let's see what that would do. Because remember, right now it's 7.5% is what we would expect to lose on average. So if we can make those numbers better, we're going to have better net profit. And what do you know? When we do that, our net profit went from 800,000. These are my simulated numbers, by the way. It's obviously going to depend on how much equity you start with, as well as your trading size. This is going to be different for everyone. But that increased by about 15% from low 800s to 961,000. Yes. Let's now use the deep back tester and not just show the last couple years of history. Let's show the full history of Bitcoin all the way to 2010. So we're just gonna have this back tested for us. Well, maybe not like that, because it does take a lot of load, but it's definitely faster than doing it by hand. And as we can see right here, over the full history of Bitcoin, not bad. 51.5% strike rate. So just better than a coin toss. But in this case, the performance summary, we can see that we have a massive advantage in terms of the average winning trade versus the average losing trade. The average winning trade returning over 10% now, the average losing trade losing just under 5% on average. So this is a winning setup. Think of it this way. If you had a coin toss and every time it hits heads, you get $10, and every time it hits tails, you lose $5, you're going to flip that as many times as you can. And that is the way that you should be thinking about statistics over time. So we want to be using these tools consistently with time as our ally, rather than thinking of just one trade need to make everything. That can be covered in different areas, different programs. In this program, we're looking for consistent growth over time. So that's it for this system. I would say that this one is viable and acceptable on those terms. Again, you can change around these inputs as you have seen, which will yield different results, of course. I want to now go into a short example so that we can see how this might operate on the other side of things. So I'll see you there. So we're back here with our good old friend, the system checklist. Now we're gonna go over a short system, which we're gonna start to play around a little bit more. I'm not gonna backtest this one by hand, but we're gonna go through the simulated backtesting results with the script. So first things first, what time frame are we gonna be trading? The hourly time frame. We are going to be on the short side of the market this time. We're gonna be using the crown cross yet again. We wanna see a downside cross here, of course. We're gonna be using the BBWP, the PMARP, and the stochastic oscillator as our sources of edge. So our different indicators to take these trades. How will positions be entered? We need to see the crown cross to the downside. We need to see the BBWP below 35 percentile again, and the BBWP moving average must be negative, and also the stochastic oscillator must be down. So this is very similar to the prior strategy, just the opposite side, different time frame as well, and we're using the PMARP to take profits. So it's more of a scalping strategy, which I do find is better if you're going to be on the short side of things, because generally Bitcoin goes up. Anyways, how will positions be exited? So profit taking. We're going to take profit when the PMARP is below 10 percentile. And what will define inverse management parameter? We'll use the same conditions as before, but just on the other side. So the Lux algo, whatever the prior highest bar was to the entry, price closes above there, take the loss. It's just going to get worse. And then I'll have some considerations here. We'll test these with the script as well, so you can see how things massively change. So I have the strategy ready over here. I want to first show this strategy when we trade all days. So Monday, Tuesday, Wednesday, Friday, Sunday. So every day you'll see the results load. I'll go over an example while we wait for it to load. And first things first, we want to see crown cross to the downside. So yellow 21 below the green 55. After that happens, we want to scan our BBWP for below 35, which is right here, while the moving average has a negative slope and the stochastic oscillator is positioned to the downside. And that actually happens exactly right here. We see a quick tick below 35. Moving average, the white portion, has a downward slope. So check 1, check 2, check 3. Stochastic oscillator also positioned to the downside. Beautiful. In this case, we're going to wait for the PMARP to go down to 10 percentile. So where's 10 percentile or lower? That would be right here about. So you can see this one is quick in and out. Again, the purpose for this strategy is to scalp. Even this one's actually within a pretty monstrous long-term uptrend. So we should take the money and run in this case. We enter at 67,521. We exit over here a little bit later at 65,861. This is almost a $2,000 trade, relatively fast as well. And again, you could maybe manipulate your take profits to allow for more of a trend trade here as well. Maybe by using BBWP instead of PMARP to take profit. You could also wait for moving average crosses as well. You could have waited for the 9 to cross the 21. But again, we're coming at this from a scalping perspective. So we have that. Okay, great. Let's look at the results if we were to trade this strategy every day. Understanding that if we trade this strategy every day, probably not going to be good for the short side of the market. And what do you know? Terrible. While it does have actually a good strike rate above 60%, it has a massive loss in the tested period. Why is that? Because the average loss is significantly greater than the average win. It's almost 2 times. The average winning trade, just under 2% for this hourly strategy. The average losing trade, around 385. But could we maybe make something of this? We do have a higher strike rate here. So perhaps we can manipulate the inputs to make something profitable. The first area that I would start is always manipulating the days. So in this case, I'll scroll down here and I want to get rid of Monday. That's for sure. Let's see if the net profit improves. It improved. We went from 150,000 loss to 128,000 loss. All right, let's try another day. Tuesday is another typically bullish day. Let's get rid of that one. Okay, we just made a lot of progress there. The net profit goes all the way down to negative 16,000 and our percent profitable, our hit rate just went up to almost 65%. Okay, so we're definitely onto something now. Now let's get rid of Wednesday. Now we have a profit. Now we're almost printing 50,000 and our percent profitable went up to just under 67%. Let's try getting rid of Friday. It's another day that's typically bullish as well. And going up again, almost 70,000 net profit with a over 70% strike rate now. Okay, now we're looking good. Let's get rid of Sunday, another day that's, well, it's not the most bullish day, but most days do not favor short strategies, just so you know, in crypto land. If we get rid of Sunday, now we have a very good strategy, actually. Now we have an equity curve that generally goes up and to the right. Our net profit is over 107,000. Our percent profitable is 73.75. And our profit factor, which is really the most important thing here, is 1.4. That means for every dollar that we bet, we can expect $1.4 back, or 1.423. So realistically, the net profit you shouldn't be too concerned with on this screen, because this is going off of my simulator account, equity starting, or initial capital, and then the order size. So that may or may not be relatable to what you're doing. Okay, so once we have that, let's see what else we can do. If we go into the performance summary here, we can see the average winning trade now 2%, the average losing trade 4%, but it has a very high win rate. Can we maybe bring the average losing trade down? Well, let's try a stop loss by percentage. So this condition would imply that if Bitcoin were to trade 2% below the entry, we would just take the loss. Just take the loss. It's going to get worse. So it'd be equal to the profit now. And what do you know? Actually, the equity curve here gets smoothed out a little bit, but our net profit does go down. Okay, what if we actually have a max take profit? So we're a little bit more greedy here with closing our hands when the money's in our fists now at 2% as well. Just play around, just see what can make sense. And if we do that, okay, things just improve significantly. We have a new higher in a net profit. Our profit factor went up to 1.7. That is the really important number. And percent profitable went to 69.5%. Our equity curve is nice and smooth and up and to the right. We have a winning strategy here. And so I think from there, you can kind of get where I'm going with this. Ultimately, it's up to you on how you want to start to manipulate these sort of inputs. But there you have some general ideas. And in fact, I'll leave you with one more. Like, let's say, I don't even know what's going to happen here, but let's say instead of taking profit when PMARP is below 10 percentile, we do it when it's below 5. So we're getting a little bit more greedy. We want to see it get even lower than what we currently have it set at. And what do you know? Profit factor actually did not go up. Or it might have gone up a little bit, but net profit did go up, more importantly. Profit factor stayed about the same, but because we're getting more trades, that net profit or that profit factor is allowing us to generate more net profit. So the profit factor matters, the total amount of trades matter, and then the percent profitable matter, because that is what is going to generate your net profit. So all of those have an interplay. And it does come down to your preference, whether you want to, go for a higher strike rate, but lower amount of total closed trades. Some people, they just don't like seeing losses that often. Fair enough. That's completely fine. And vice versa is completely viable as well. That's up for you to play around with and for you to decide. But we'll leave it there for this short strategy. And I do want to say that this short strategy's testing period goes over the last 3 years till 2021, this being recorded in 2024. So this goes through some of the most bullish of bullish markets, especially recently. And it does continue to be consistent here. So I'll leave it right there, and I will see you in the next one where we go over a completely different strategy using similar tools, but we're going to really manipulate things to make something more customized so you can get an idea of how open-ended this can be and how personalized it can be to your own taste. I'll see you there. We're back at our good friend, the system checklist. And in this one, we're going to go over kind of just an example of just a weird strategy, just playing around with different things, using different inputs for indicators. And I want to really emphasize that you can customize this to your heart's content. You have the overall blueprint, you have the overall knowledge. Now it is time to apply that in different ways that you really want to test. So in this case, we're going to go over an hourly strategy. This is going to be a long strategy. We're going to use PMARP not just for take profit, but we're also going to use it to enter as well. And we're going to be essentially long scalpers. So that is the preference here. Anyways, first things first, what time frame? Hourly. Long or short? Long. We're going to be using the Crown Cross, the BBWP, and the PMARP. Now, I did make a note here that I want to test a couple different settings. We're going to test the default PMARP. We're also going to test something completely different look back, different length, and different EMA type or different moving average type, and see if the results differ or are better. How positions be entered? We want to see the Crown Cross the upside, so the 21 must lead the 55. We want to see PMARP below 18, so we're going to be using that for an entry condition. And then the BBWP moving average, we want to see that negative or having that downward slope. We'll also check what it looks like when it's off as well, but I need to remind myself to show that. How positions be exited. So whichever happens first, PMARP above 77 percentile, or we're going to have just a general take profit at 2.1% above our entry. We're going to test both with and without that condition. We'll also have the same risk management parameter before using our good old friend, the Lux Algo support and resistance. And we will also try a stop loss by percentage of 1.3. And then of course, other considerations, maybe we play around with days traded, maybe we have a higher term time frame trend filter, and then of course the take profit and stop loss. So let's get into it now. Let's first go over an example, just identifying an entry. So I want to, on my PMARP, outline 18. There we go. Close enough. And then we need to see crown across the upside and moving average negative. So, all right, we can very easily see the crown across the upside starting right here. Yellow 21 is above the green 55. Okay, simple. Now we look for the PMARP condition to be met, and we see that happens starting about right here. Now we go and cross-check the BBWP moving average, and in this case, yes, it does have a negative slope from the prior close to the current close. That is a downward slope. It is continuing down. Again, that white portion of the BBWP represents the moving average. So our entry would be 66,132. Great. Our exit is going to be when PMARP is above 77 percentile. So let's mark that area off first, right about there. And let's see where that gets hit. Gets hit way over here. Let's see what price looks like at that time. And you can see we buy 66,132. We sell 71,020. Actually, not bad. I'll take it. I'll take it. So this is with just the default PMARP, by the way. Okay, so now you have an idea of how that's going to look. Let's just use our cheat code here. Bring up our script to test this, and I can see that over the full history of Bitcoin, this has traded for a just over 66.30% strike rate. The profit factor is 1.82, so that means for every dollar that we risk, we make 1.82 back. And if we go into the performance summary, we can see that the average winning trade printed almost 3% for an hourly time frame. This is very, very good. Again, think in terms of long term, think in terms of hundreds of trades, think in terms of if you are using leverage, perhaps that gets multiplied even further. Doesn't take too much. For the average losing trade at just over 3.16%, okay, this is very obviously going to be viable. But can we make it better? It's always the question, and always the obsession, which it should be. So first things first, let's try to omit trades that happen on Thursday and Sunday. That's always a good start with these sort of strategies, long strategies that is. So let's retest that, see if things improve a little bit or maybe not. I mean, it could be that it was actually benefiting from those throughout this testing period. We won't know until we test it, of course. Our net profit actually did go down, and our profit factor did go down as well. So objectively, that was not an improvement. We want these days. This one's actually benefiting from every day, or at least those days that we tested as well. Okay, what else can we test here? Let's manipulate the PMARP. Remember, we wanted to test a different setting for that. So let's go back into it here. Let's test the 300 look back, 13 length, and type EMA. So right now it's default. Let's just completely change it. See if that improves things. So EMA, we're going to be 13 length, and it was 300 look back. Okay, great. See how that changes things. And there we have it. The percent profitable has gone up to just under 71%. The profit factor has gone to 177. So the profit factor did go down a little bit, but we got more trades overall. Because we're getting more trades and the profit factor is still very comparable, I'd say, the net profit is actually, I would say, quite good here too. And we can see that equity curve continues up and to the right the whole way through. Okay, this is starting to look very good. The average winning trade, 2.25%. The average losing trade, 311. All right, so very quickly, I just wanted to show why I typically have some sort of volatility condition, as it is a really good filtering condition for almost any strategy. It will have some sort of edge to it. Almost always, not always, but almost always. So now that we've gone through the last strategy here, we've gone through one long, one short, and one wild card. I want to start to bring this whole course together and really start to close off this loop that we began from the first lesson and video, and I will see you in there. By the way, I just want you to know, as a student completing this whole course, we're going to offer you a special discount code for this script right here so that you can back test at your heart's desire and also even automate your trades as well if you so desire. So now we're here at the very end of this whole course. I want to say a sincere congratulations. You're one of the very proud people who've actually made it all the way through here. And really, I want to commend you on that because it does take a lot of concerted effort and a lot of studying, and that really does set you apart and is what is going to make you successful in this endeavor of trading. So now that you're at the end here, what have we done? What have we essentially gone over? You came here because you wanted to have some sort of an edge or a statistical probability that gave you a favor in the markets, whether the markets go up or down, essentially beating the casino of the market and making it your own casino. And while we didn't have to go over the really complicated mathematical formulas of Black-Scholes and geometric Brownian motion, just like you can operate a car without seeing the engine, you are using that as your engine within this system. You came here to learn a trading system that is based off of mathematics and objective indications rather than emotions. We've done that in our system checklist. We set up conditions that are only ever present or not. There is no ambiguity as to whether you should ever be entering or exiting. You either have the green light or the red light. You came here for a fully formed framework that reduces very complicated mathematics into simple but accurate trading signals. That was with our framework of trend, volatility, and momentum, which we then improved upon with our other indicators like PMARP, and of course manipulating these statistics that we generated from those systems to optimize. You came here to beat any market, whether it's up or down, by going long or short. And we did that by understanding the first and most important priority in this whole course, which is trend is number one. Trade with the trend. You also came here because you wanted to build some sort of a system around your personal preferences. And we did that by optimizing the system and showing you how to customize certain inputs so that you may make it directly applicable to yourself, whether you're trend trading or whether you're scalping, whether you want to go long or short. All of these things are now up to you to go ahead and test. You came here because you wanted a global network of like-minded individuals. This is a network that you will have for life. You'll be surrounded by people who have gone through the exact same process, and you can bounce ideas off of them, you can help one another, and you will naturally build off of one another as you share different things that have worked for yourself. And also as you come across people who are maybe one more step ahead of you that have a little bit more to share, or maybe one step behind you that you have something to give towards. All of this is intended to create a more well-rounded and holistic means of incorporating the content. And I just want to let you know that you will always, for the rest of your life, have access to this course content. And it is really intended to be viewed multiple times over as you assimilate the content and grow as a trader. Lastly, I want to say again, a sincere thank you for getting through this whole course. And I want to congratulate you for getting through this whole course, because for myself, I know what it was like to really be completely on my last legs and have no idea what I should be doing. And for me to be able to pass on what has worked for myself to other people out there who it might be of value is a tremendous responsibility and also is extremely fulfilling. So I want to thank you for allowing me to be a part of your journey, and I wish all of the best for you, and I will see you around.